Hello everyone. At first glance, the Japanese yen weakening after a Bank of Japan rate hike appears counterintuitive. Normally, higher interest rates support a currency. However, in Japan's case, the yen's decline is not a policy contradiction, it is a structural move. The key driver for yen is not short-term policy rates but long-term bond yields. Despite the recent hike, Japan's long-end yields remain exceptionally low relative to its fundamentals. With gross public debt near 240% of GDP and net debt around 130%, Japan should, in theory, have higher long-term borrowing costs. Yet Japan's 30-year government bond yield is still lower than Germany's, despite Germany having far lower public debt. This clearly indicates that Japanese yields are being artificially suppressed rather than being set by the markets. The structural weakness is also reflected in the real effective exchange rates, which adjust for inflation and trade competitiveness. The yen is now trading near the weakest end of the global rear spectrum, close to the levels seen in the currency Turkish lira. This confirms that the yen's weakness is structural, not cyclical. The reason lies in the Bank of Japan's continued bond purchases. The Bank of Japan remains a dominant buyer of the government debt, preventing long-term yields from rising. Without this support, yields would likely spike, rising a debt crisis. As a result, policymakers face a choice: allow yields to rise or accept continued currency debasement. So far, the latter has been preferred. From a technical perspective, if we see the daily chart frame of USDJPY pair, the pair remains in the firm medium-term uptrend. The 50-day and 100-day moving average continue to slope higher and price is consolidating near the 156 to 157 resistance zone. A sustained break above this area could open the upside towards 157.96, and a breach of this level can make the pair to reach 158.87 levels, while pullbacks are likely to remain shallow, and the support levels can be seen around the 50-day and 100-day moving averages. From a hedging standpoint, JPY importers should hedge near-term exposure at current levels around 0.5650 to 0.5675 levels, while exporters may wait for levels above 0.5800 to restart hedging. The takeaway is clear: rate hikes without yield normalization will not change the yen's long-term trajectory. Thank you and stay tuned for more updates.